Gold and silver prices experienced catastrophic collapse following what market participants are calling the red button moment, a systematic trigger event that initiated mechanical liquidation processes across global precious metals markets. This wasn't gradual price discovery through fundamental supply-demand changes or normal market correction following overextended advances. This represents systematic destruction of leveraged positions through coordinated liquidation that operates independently from physical market conditions or long-term investment considerations. Understanding the red button concept requires examining how modern financial markets operate through interconnected systems, where individual events can trigger cascading reactions across seemingly unrelated asset classes and geographic regions. The red button moment represents the specific instant when systematic risk management protocols activate simultaneously across multiple institutions, creating coordinated selling that overwhelms normal market absorption capacity, regardless of underlying asset fundamentals. The mechanical liquidation process began when predetermined risk parameters reached critical thresholds that triggered automatic position reduction across hedge funds, commodity trading advisors, and institutional investors with significant precious metals exposure. These automated systems operate independently from human decision-making, while executing pre-programmed strategies designed to reduce risk exposure when volatility exceeds acceptable parameters. Risk management algorithms monitor multiple indicators including portfolio value at risk, correlation breakdowns, liquidity metrics, and volatility measurements across different timeframes. When these indicators reach predetermined levels simultaneously, they trigger systematic position liquidation regardless of individual asset merit or longer-term investment outlook considerations. The mathematical precision of these systems creates coordinated selling that appears deliberate but actually results from systematic risk management protocols. Leverage unwinding created the most devastating component of the precious metals collapse because borrowed money amplifies both gains and losses while forcing immediate action when positions move adversely. Margin requirements increase dramatically during volatile periods while forcing leveraged investors to choose between providing additional capital or accepting forced position closure at potentially catastrophic losses. The mathematics of leverage work against investors during extreme volatility because small adverse price movements create disproportionate portfolio impacts. Investors utilizing 2-to-1 leverage face complete position loss from 50% adverse price movements, while higher leverage ratios create exponentially greater vulnerability to volatility-driven destruction. Hedge funds and commodity trading advisors that utilized leverage to enhance precious metals returns found themselves trapped when prices declined rapidly enough to trigger margin calls requiring immediate response. The compressed timeline for margin call responses prevents orderly liquidation while forcing simultaneous selling that compounds downward price pressure across affected markets. Prime brokerage relationships complicated the liquidation process because multiple hedge funds often utilize the same prime brokers for financing and trade execution. When systematic margin calls affect numerous clients simultaneously, prime brokers face concentrated risk exposure, while potentially lacking sufficient capital to support all client positions during volatile periods. Options. Expiration timing created additional systematic pressure because large options. Positions approaching expiration required hedging adjustments that forced underlying futures purchases or sales, depending on option positioning and current market prices relative to strike levels. The quarterly options expiration cycle concentrated these hedging requirements into specific time periods when market liquidity often becomes reduced. Gamma hedging requirements forced options. Market makers to adjust underlying positions as precious metals prices moved through different strike price levels. When prices decline rapidly, market makers must sell underlying futures to maintain risk neutrality, while their hedging sales accelerate underlying price declines in self-reinforcing cycles that continue until options positions expire or prices stabilize. The options market structure in precious metals shows heavy concentration around psychologically significant price levels, including round numbers and technical support levels that attract large position clustering. When prices break through these levels rapidly, concentrated options. Positions require simultaneous hedging that creates massive underlying selling pressure. Professional options. Traders often maintain complex spread positions that require dynamic hedging across multiple expiration dates and strike prices. During extreme volatility, these sophisticated strategies can malfunction when normal market relationships break down while forcing unexpected hedging requirements that contribute to systematic liquidation pressure. Margin call cascades began when initial precious metals price declines triggered margin calls for leveraged investors, while their forced selling created additional downward price pressure that triggered subsequent margin calls for other market participants. This cascading effect continued until selling pressure overwhelmed available buying interest or prices declined sufficiently to eliminate margined positions. The timing of margin calls creates particular devastation because most investors face similar margin requirements and risk management protocols. When markets experience systematic stress, margin calls concentrate into narrow time periods when market liquidity becomes least capable of absorbing selling pressure without dramatic price impacts. Automated margin. Call systems operate continuously while monitoring portfolio values in real time against required maintenance levels. These systems generate immediate liquidation orders when portfolios fall below required thresholds without regard for market conditions or potential recovery prospects. The mechanical nature of these systems prevents negotiation or delay while forcing immediate execution regardless of market timing considerations. Cross-margining relationships between different positions can accelerate liquidation when declining values in precious metals positions affect overall portfolio margin requirements for other asset classes. Investors may find themselves forced to liquidate precious metals positions to meet margin requirements for unrelated investments when overall portfolio volatility exceeds acceptable parameters. Paper market dynamics enabled massive price manipulation because futures contracts and derivative positions represent claims on metal quantities that far exceed available physical supplies while operating through centralized exchanges that can implement emergency procedures during extreme conditions. The concentration of paper trading through limited venues creates single points of failure that affect global precious metals pricing. COMEX precious metals futures show open interest levels that represent metal claims exceeding global above-ground inventories by substantial margins, while most contracts settle through cash payments rather than physical delivery. This mathematical impossibility means paper prices can deviate dramatically from physical market conditions when normal arbitrage relationships break down during crisis periods. Exchange-traded funds tracking precious metals prices face redemption pressures during volatile periods that force underlying asset sales exactly when markets become least capable of absorbing additional selling without dramatic price impacts. Large ETF redemptions can trigger systematic selling that operates independently from fundamental precious metals supply-demand considerations. Algorithmic trading systems designed for normal market conditions often malfunction during extreme volatility while executing strategies based on historical relationships that may not apply during crisis periods. These systems can generate massive selling orders when technical indicators reach predetermined levels without regard for market absorption capacity or fundamental considerations. Physical market scarcity paradoxically fails to provide immediate price support during paper market liquidation because physical and paper markets operate through different mechanisms with limited arbitrage connectivity during extreme conditions. Physical dealers report continued strong demand and supply shortages, while paper prices collapse due to leveraged liquidation that operates independently from physical market realities. The disconnect between physical and paper markets becomes most pronounced during systematic liquidation events when normal arbitrage traders withdraw from markets unable to manage risks effectively. Without active arbitrage, paper prices can deviate substantially from physical market conditions, while creating temporary opportunities for sophisticated investors with adequate capital and risk management capabilities. Physical precious metals premiums typically increase during paper market stress as investors recognize the relative safety of physical ownership compared to leveraged paper positions. However, premium increases may lag. Paper price declines by days or weeks, while physical market participants assess whether price declines represent temporary paper market disruption or genuine fundamental changes. Dealers in physical precious metals often struggle to adjust pricing rapidly during extreme paper market volatility because their inventory costs and replacement availability depend on longer-term supply relationships rather than instantaneous paper market pricing. This creates temporary arbitrage opportunities while potentially contributing to physical paper price disconnection. Premium monitoring becomes crucial for distinguishing between temporary paper market disruption and genuine fundamental changes in precious metals supply-demand relationships. Rapidly widening premiums suggest paper market dysfunction, while stable or declining premiums may indicate broader fundamental weakness affecting both physical and paper markets. Stabilization signals emerge through multiple indicators including reduced volatility, increased trading volume at stable price levels, premium normalization between physical and paper markets, and resumed normal arbitrage activity between different market venues. These signals typically develop over days or weeks rather than hours, while requiring careful interpretation during uncertain market conditions. Volume analysis provides important stabilization indicators because genuine price discovery requires adequate participation from both buyers and sellers willing to transact at current price levels. Low volume during price declines suggests forced selling rather than genuine price discovery, while increasing volume at stable levels indicates renewed market participation. Technical analysis becomes complicated during mechanical liquidation because traditional support and resistance levels may prove irrelevant when systematic selling overwhelms normal market structure. However, extreme oversold conditions and momentum divergences can provide useful signals for potential stabilization timing even during highly unusual market conditions. Market breadth indicators across different precious metals and related sectors can provide confirmation of stabilization or continued deterioration. When gold, silver, platinum, and mining stocks begin moving independently rather than declining in coordinated fashion, it suggests systematic liquidation pressure may be diminishing while normal market relationships resume functioning. Reset versus regime change analysis requires distinguishing between temporary mechanical disruption that will reverse once liquidation pressure subsides versus fundamental changes in market structure, regulatory environment, or economic conditions that create permanently altered precious metals market dynamics. Reset scenarios involve temporary price dislocations caused by leverage unwinding and systematic liquidation that reverse once mechanical pressures subside and normal market relationships resume functioning. Recovery patterns typically show rapid price rebounds toward previous levels once selling pressure diminishes and normal arbitrage relationships reconnect physical and paper markets. Regime change scenarios involve permanent alterations in market structure, regulatory frameworks, or economic conditions that create lasting changes in precious metals, demand, supply, or pricing mechanisms. These changes typically develop over longer periods, while creating new equilibrium price levels that may differ substantially from previous ranges. Central bank policy responses provide important regime change indicators because monetary policy changes can permanently alter the attractiveness of non-yielding assets like precious metals relative to interest-bearing alternatives. Emergency policy interventions during crisis periods may indicate systematic problems requiring longer-term structural adjustments. Regulatory changes, including position limits, margin requirements, or trading restrictions, can create permanent market structure changes that affect pricing dynamics and investor participation patterns. Emergency regulatory measures implemented during crisis periods sometimes become permanent features that alter long-term market behavior. Geopolitical developments, including sanctions regimes, trade restrictions, or international monetary system changes, can create permanent shifts in precious metals, demand patterns that constitute regime change rather than temporary disruption. These changes typically persist beyond immediate crisis resolution while creating new structural demand sources. Currency market relationships affect precious metals pricing through multiple transmission mechanisms that can experience temporary disruption during crisis periods or permanent changes during monetary system transitions. Understanding whether currency relationships show temporary stress or fundamental realignment helps distinguish reset from regime change scenarios. Interest rate environment changes create lasting effects on precious metals. Attractiveness, because yield competition affects investor portfolio allocation decisions over extended periods. Temporary interest rate volatility during crisis periods differs from permanent interest rate regime changes that alter the relative attractiveness of different asset classes. Inflation expectations provide another regime change indicator because precious metals serve as inflation hedges during periods when currency purchasing power faces systematic threats. Temporary inflation fears during crisis periods differ from permanent inflationary regimes that create lasting demand for inflation protection assets. Banking system stability affects precious metals markets through multiple channels, including credit availability for leveraged positions, derivative contract reliability, and safe haven demand during financial system stress. Temporary banking stress during crisis periods differs from permanent banking system changes that alter long-term precious metals demand patterns. International trade relationships influence precious metals markets through industrial demand, cross-border capital flows, and currency competition that can experience temporary disruption or permanent realignment. Distinguishing between temporary trade disputes and fundamental changes in global trade patterns helps assess regime change potential. Technology developments, including digital currencies, blockchain applications, and electronic trading systems, create gradual changes in precious metals market structure that may accelerate during crisis periods. These technological changes typically represent regime change rather than temporary disruption, while requiring adaptation by market participants. Market structure evolution, including algorithmic trading penetration, institutional participation patterns, and retail investor behavior, shows both temporary crisis responses and permanent behavioral changes, understanding which changes persist after crisis. Resolution provides insight into long-term market structure evolution. Liquidity provision mechanisms face both temporary stress during crisis periods and potential permanent changes if market makers or institutional participants permanently reduce precious metals market involvement. Changes in liquidity provision can create lasting effects on market efficiency and price discovery mechanisms. Monitoring approaches should incorporate multiple indicators across different time frames while avoiding over-reliance on any single metric during uncertain periods. Professional precious metals. Investors typically monitor physical premiums, futures curve relationships, options, market behavior, currency correlations, and broader financial market conditions simultaneously. Real-time premium tracking provides immediate feedback about physical market conditions while futures curve. Analysis reveals longer-term market expectations and financing costs. Options, market volatility, and skew patterns indicate investor positioning and expectations while providing early warning signals for potential systematic changes. Cross-asset correlation analysis helps distinguish precious metals, specific developments from broader systematic factors affecting multiple asset classes. When precious metals move independently from traditional correlations, it suggests sector-specific factors, while coordinated moves across multiple assets indicate systematic influences. Global market timing considerations become important because precious metals trade continuously across multiple time zones, while crisis events can occur during periods when specific regional markets remain closed. Understanding which trading sessions show the most reliable price discovery during crisis periods helps optimize monitoring and decision-making timing. News flow analysis requires careful interpretation during crisis periods because immediate reactions to headlines may prove temporary, while longer-term implications develop over extended periods. Professional analysis typically focuses on structural developments rather than daily news while maintaining awareness of potential systematic triggers. Risk management during uncertain periods requires conservative position sizing, adequate liquidity reserves, and flexible strategies that can adapt to either reset or regime change scenarios. Avoiding excessive leverage becomes particularly important when mechanical liquidation risks increase while maintaining some precious metals. Exposure provides portfolio insurance against systematic monetary risks. The educational value of red button moments extends beyond immediate market impacts to encompass broader understanding of how modern financial markets operate through interconnected systems, where systematic risks can create coordinated responses across seemingly unrelated investments. Understanding these dynamics helps investors develop more realistic expectations about market behavior during crisis periods. Historical precedent shows that mechanical liquidation events typically resolve within days to weeks once systematic pressures subside and normal market relationships resume functioning. However, some crisis periods do represent genuine regime changes that create permanently altered market conditions, requiring strategic adaptation rather than tactical positioning for recovery. The complexity of distinguishing reset from regime change during real-time crisis conditions requires patience and comprehensive analysis rather than immediate reactions based on initial price movements. Professional approaches typically involve preparing for multiple scenarios while monitoring key indicators that reveal which scenario appears most likely as events develop. This analysis examines the mechanical processes underlying precious metals, price collapse rather than providing investment advice or predicting specific outcomes. Understanding these dynamics provides educational context for evaluating crisis periods, while recognizing that market behavior during systematic stress often exceeds historical precedents and analytical frameworks designed for normal market conditions.